think there is opportunity. The reality is that the regulations that we've seen in the last year or so are a catch-up. China tends to like to let businesses run, and then when there are ill effects in achieving the goals of the country, it then clamps down on regulation. So in this case, I think it probably considered that capitalism had gone too far. But if you look at the regulations, they're aimed very clearly at issues to do with cybersecurity data, to do with the fact that families aren't growing as much as, don't have as many kids as they'd like. So if you look at the areas where the government would actually be on your side in terms of aiding the sector, you have a whole host of areas where you can invest. Consumer goods, for example, is an area. Anything to do with, that's not monopolistic, that has to do with digitalization would be helpful. And also, there are ways to invest in China without investing in Chinese stocks. So you can invest in Japanese stocks, Korean stocks, Taiwanese stocks, all sorts of stocks that actually market into China where the growth and consumption will still grow.
But you're still underweight Chinese equities, right, at this point in time. Does the recent sell-off make Chinese company worth the risk, or do you think they need to really come down a bit more before you'd be more interested in increasing your portfolio and your exposure?
So we have very strict criteria on our investments. We look for good companies that are trading with a margin of safety and where management has shown a good track record of reinvesting capital. And the most important thing is that management's interests are aligned with ours, the minority shareholder. In the case of China, when there's so much regulatory change going on, and I don't think it's over yet, it's very difficult to ascertain if that alignment of interest is there. With China, particularly with the SOEs taking up such a big chunk of the index, it makes sense to underweight the market because a big chunk of that market are SOEs whose interests are not aligned with investors at all. They are there to carry out government policy.
That's an interesting point that you make there. Given that about a third of U.S. hedge funds had exposure to ADRs at the end of the second quarter, do you think that the hedge fund community did not see what was coming with regard to regulation? Do you think they should have known, given your comments with regard to the Chinese companies and their relationship with the government, that they should have known what was coming and maybe pared back exposure beforehand?
You know, it's really difficult to say because many of the companies that listed in the U.S. were particularly attractive and perhaps maybe not so much for the hedge funds, but for investors who don't have easy access to the Chinese market, they looked attractive. For the hedge funds, you know, maybe they should have known better. I really can't speak about how people look at deciding what to invest in. The fact is, if you were underweight China as we were, we suffered for many years because we were concerned about the risks. So to have made up that difference now because of the decline in the ADRs might be helpful for us, but you know, I wouldn't guess that it wasn't a measured, considered decision to invest in those ADRs. We have kept away from it.